I think that has been very good cooperation on this event. I hope to cooperate with you more in the future. Now, what I'm going to do today, I will start from a very high level, macroeconomic level, of why we are talking about capital markets union today, and then I will go down into the details of the economic and legal barriers that are obstructing the creation of a full-fledged capital markets in Europe. Now, this report is roughly a 300 pages report that is the result of a year-long discussion with experts, academics, and policymakers. So we brought together in Brussels top academics in financial markets together with European and some national policymakers. What we highlight in this report, about 36 cross-border barriers to integration, capital markets integration, and we suggest 33 policy recommendations. But without further ado, let me go into the substance of this report. Now, the first thing that we want to understand is that how is the financial integration process developed over the last 20 years, also thanks to the introduction of the euro. And when we talk about financial integration, we need first to agree on what is financial integration. And here we try to give a definition that is correct enough to build upon policy actions. Financial integration is the process through which different regions and countries become more financially interconnected. This process involves the free circulation of capital and financial services, and it usually determines an increase in capital flows across regions, private risk sharing, so the cross-border holdings of assets, of financial assets, and a convergence of prices and returns for financial assets and services. Now, I take the picture of the euro area because it's where we have a very good indicator prepared by the ECB. The brown line is a price-based indicator, so it tells you, in a sense, the dispersion of asset prices across the euro area. The higher it is, the more convergence and the less dispersion among asset prices. And the lighter one is the quantity-based indicator that tells you essentially the size of cross-border holdings of assets. If you see from the beginning of the euro area, thanks also to the monetary union, we had a huge and fast spike in price convergence. So we had a very important increase in convergence of asset prices, which was only partially, followed up by an increase in quantity-based flows. So in cross-border holdings of this asset, which means risk sharing. So the ability to take risk, to share risk across the board. With the crisis, you had, as you can see, an immediate adjustment in price convergence. We realized all of a sudden that, yes, the asset price convergence was not reflected into a sharing of risk. So when the crisis hit, we realized that this financial integration was mainly driven by interbank market flows, which are senior financial claims that when a systemic risk hit an area, they are the first type of capital that retrench immediately in their own borders. So we've seen this capital flowing back in domestic countries, and therefore the asset price convergence reduce and adjust to a level similar to the quantity-based convergence. Now, after the crisis, now we are picking up again in terms of financial integration, but the result is that these two lines are starting to diverge in the same fashion that they used to diverge before the crisis. So the question is this financial system, maybe I stand, is this financial system equipped to avoid, again, this huge difference between price and quantity-based indicator, which means possible concentration of capital flows in specific areas. So this kind of environment is conducive to potential asset bubbles. So how can we reduce that? How can we avoid that price convergence gets followed up by the quantity convergence? Capital markets union is and banking union together, because when we talk about risk sharing, it's not just about cross-border capital markets, but also about cross-border banking activities, which at the moment in Europe are close to 3 to 4%. So, when then we talk about risk sharing, and here there is a lot of misconception about the role of public finance to absorb a systemic crisis or a systemic shock. If you look at the numbers, fiscal transfers, let's look at the United States, which is this bar here. Fiscal transfers accounts only 20% of the risk absorption capacity of a financial system. The other 80% goes mainly into savings, your savings, and in capital markets and credit banking activities, which is essentially in the form of capital gains or interest rates, so profits related to this type of transactions. So even though we had a huge bailouts in 2008, 2007, with the statistics and the analysis that we also have run, but also the ECB has updated recently, shows that that still the public finance transfer has been only the 20% of the absorption capacity. So even though we bailed out banks, most of the hit has been absorbed by banking activities, capital markets, and savings. And most importantly, in the European, in the euro area and in Europe, has been completely smoothed, which means has been a huge hit of consumption. So the lack of this absorption capacity has hit completely cross-border consumption. So it did not only affect the financial system, but it also affect the markets for goods and services. So this kind of financial system is, at least at European level, is not conducive to financial stability. And in fact, the cross-border element, which is this one, so this one includes cross-border banking and capital markets activities, which in the US accounts for 40% of the absorption capacity. It's even negative at European Union level. So when a crisis hits, our financial system, how is it structured today, it then enhances the shock. It doesn't absorb it at all. While in the euro area, you have some absorption capacity, but it's in the range of 2 or 3%. So very small absorption capacity at euro area level. So this is a very important financial stability problem in the first place. And then it comes down to the problem of credit conditions, of SMEs and other types of non-financial corporation, which I get there in a moment. I'll show you some interesting numbers on that as well. If you look at investment flows, what is the purest form of risk sharing? Purest form of risk sharing is equity. Is the fact that you take risk capital in a company or risk capital in an asset, you are essentially taking some of the risk. If you look at Japan and the European Union, selected the US, selected euro area countries, most of the investment flows are debt, are essentially debt, which adds up to the point of not having sufficient risk sharing, not just in the form of cross-border holdings, which I showed you, but also in the form of quality of capital flows, which are low in terms of FDI and equity, compared to the size that they could reach, actually. If you look at Canada, United States, Australia, Hong Kong, the vast majority of investment flows are equity. So that brings me to first initial finding. Look at the composition of the financial sectors in the EU, US, China, and Japan. It's not a case that the most financially unstable at the moment, and at least in the last few years after the crisis, are still the European Union and China, because these are financial systems where the weight of the traditional banking sector. Let's not get wrong here the discussion. I'm not talking about banks versus capital markets. I'm talking about traditional banking activity versus capital markets, because in capital markets the vast majority of the players are banks as well. So we're talking about the fact that traditional banking activities is the dominant funding way for all corporates and institutions at European level. Look at the role of equity markets in Europe. Is the smallest across all the advanced economies. It's only about 64% of the GDP, while it's 127, the double in the US, and 76% even in Japan. So this should start to raise some eyebrows of how our financial system is structured. If that is not enough, if the financial stability argument is not enough for you, look, we develop in the first chapter at least other 4 areas in which market-based mechanism can actually improve the quality of our financial system. Monetary policy transmissions, access to finance, because it's a main competitor of traditional funding channels, and provides the type of finance that banks do not provide. Risk dispersion and customization that, for instance, crowdfunding offers or equity markets offer are not some type of funding mechanism that banks. So here we're talking about competition if we go in the debt security space, but in the equity space, actually there is no competition. Market-based finance and funding provides a type of finance that banks cannot provide and will never provide. Finance for innovation. We have recent literature showing that market-based finance is the best type of funding for innovation, for startups. You know that more or less, I think you are aware of the fact that in Europe our private equity venture capital markets is almost non-existing. If you look, also in my spare time, I'm part of a business accelerator based in London. Startups, small firms, they usually do the first round in their own country, family money or friends giving them some money. Second round, they barely can raise any money in their own country. If I look at Italy, where I come from, most of the funding, it's private equity is almost, there are, I think, 5 private equity funds in Italy or so. So if they manage to raise the second round, it's in Italy. Otherwise, it's going to be London. Maybe the third one can be London as well. Third or fourth then becomes the United States. So most of these very innovative startups most of the time move to the United States because they do not have enough funding in Europe. And that's a huge loss of know-how. And that tells you that without equity finance for this type of firms, there will be no future for them. So they just go somewhere else because they can afford the debt finance for this type of innovative type of new technologies and so on. So, and the last, which I think is the most interesting, especially for Italy and France, is the role of capital markets to allow bank restructuring. Now, the non-performing loans problem stays there, and I think we'll be talking about it for years, and Mario Draghi made this very clear. But there are market solutions that are possible thanks to credit enhancements offered also by state guarantees. And I think the recent agreement between DG Comp and the Italian government to create this fund supported by credit guarantees by the state could be an example of a way in which at least banks that are on the verge, not those that are completely broke, because you won't find invested by broke banks, could actually restructure faster through this type of market-based mechanisms. And the securitization process is essentially an important aspect of it. And I think the Commission will also, has already put forward a proposal, and by the end of the year we should have the Parliament agree at least on another draft. So things and discussions are advancing in that space. So what's Europe's financial structure? I already made clear that Europe's capital markets are very much constrained. The only 2 markets that are, I would say, competitive in terms of size and liquidity are financial securities, debt securities market, financial institutions debt securities markets. Despite the bail-in discussion, they're still active. 69% of GDP is government debt securities. But that's not a sign of a healthy financial system necessarily, because financial institutions are raising money on the debt securities markets more than in the past because also of financial needs that we are experiencing in terms of new funding needs for banks. And as well as governments, this is not certainly sign the fact that governments are raising more money in the markets necessarily of positive development. If you look at the corporate bond markets, now we have new data from China. Actually, this number is higher. It's the smallest markets across the advanced economies, and China as well. Because they changed recently statistics, and apparently it should be higher than that. I did not have time to amend this chart. Now, if you look at the financial resources of households, which ultimately are those providing funding to the economy, the banks and the private equity, the investment funds are an intermediation channel. If you look at financial assets of a household, compared again to the United States, but don't get me wrong, I'm not comparing the United States because it's our ideal model, because it's a market where you have very liquid capital markets and well-functioning capital markets, where there is, of course, a level of market activity that could be potentially a point of reference. Now, but we're not going to the United States. Of course, we have different characteristics. But let's look at the numbers because they're pretty striking. About 31% of financial assets of households in Europe are cash and deposits, compared to 13% in the United States. We made a simple calculation by removing all liquidity that goes back into the system. We assessed that there is about 1.8 trillion euros of cash and deposits that could be reallocated to more profitable investments. That could be investment funds units, could be direct holding of shares. In fact, if you sum up these two, so the direct holding of shares and investment funds unit in the EU, we are about half of what is the average households hold in the United States. So there is not enough market activity for household, but there is not even enough market offer in terms of competition in the investment fund space to provide more products and more services. And insurance and pension funds play more or less the same role in the United States and Europe. Of course, the picture is completely different across the EU. I'm not going to explain that. The UK and the Netherlands, for instance, are those where you have more investments in financial markets. In a country like Greece, Italy, you have much less of activity. Now, this is the interesting chart about non-financial corporations funding. This is the liability structure of non-financial corporations in the EU, US, Japan, and China. What we see essentially is that, on average, European firms are smaller than US, Japanese, and Chinese firms, but of a fairly big margin. So non-financial corporation liabilities in Europe are about 100% of GDP. They are 143, something like that, in the US, 150 in Japan, and 160 in China. That tells you something, that essentially, if we look at the composition of the liability side, it's not necessarily the lack of debt funding of bank loans, in this case, and corporates. If you sum this up, essentially, you get more or less the same relative importance than other regions. But what really lacks here, in relative terms, is the equity market's contribution, the equity capital. So this gap is mainly due to the lack of equity capital and perhaps debt securities, market debt securities. But to this, I would say, to some extent, what we see essentially is that there is a big lack of equity capital in non-financial corporation. And in fact, if you look also at this lending service of the ECB, the request for funding is scoring systematically after the crisis below what the expected level that banks calculate every month. So the question is, are firms asking for more traditional credit? The answer is no. It's not that there are firms striving to get money from a bank out there. There are perhaps some issues with some small enterprises, but most of the firms out there are not asking for more funding. So the question is what they are asking. Well, let's look at the debt funding structure of non-financial corporation. In Europe, most of the debt funding, 80%, is bank loans versus 20% of corporate debt securities. Now, what's the state? And here maybe I just go faster. There is a chapter 3. It's a 100 pages chapter where you have all charts about all the segments of financial markets in Europe, and there are conclusions about it. I just summarize a few items here. First of all, our equity markets, just to emphasize also the equity issue, still are very much fragmented across geographical lines and lacked depth and quality. And I'll show you a few charts. Bond markets are merely OTC, but if you try to calculate a ratio of turnover over market capitalization for equity and turnover over value of outstanding debt securities in bond markets, you get a similar ratio. So their ratio between market activity of bond markets and equity markets is the same, even though bond markets are over the counter. So it tells you that not bond markets, there's nothing wrong. Perhaps our equity markets are not sufficiently active, sufficiently liquid, compared to that ratio that in the United States is 3:1. Europe is 1:1. Private placement securitization are and will remain niche markets. That's for sure. So we need to boost their use, but still we need to be realistic on what they can actually achieve. Now, asset management industry remains very fragmented and costly, not necessarily because there's not enough competition at the top, which somehow there is. We have seen a lot of new asset management company entering in Europe and offering products in some countries. The problem, in fact, is the bottleneck of the distribution channels. The distribution channels are in many countries, including I think Italy and I think a bit, France as well, are pretty much closed. So the cost of selling investment products and buying investment products is relatively high. And it's about 1/3 more than in the United States. Now, if you look at the Commission is going to look into this in distribution channel, is going to launch a consultation in May, so this month. Dealer banks continue to scale down their trading activities, so they are not going to be the players for capital markets, not as they used to be in the past. So until they find a new business model, we are going to see still banks shrinking their activities and trying to be replaced by someone else that should take their role. Short-term cost funding for SMEs has gone up, but I won't explain more and go into details for that. But just to show you a few charts, this is the aggregate turnover of European stock exchanges, about 9 trillion euros. This is the aggregate turnover of US exchanges. We're talking about 20% of the US market. To show you a bit, just to give you a sense, a graphical illustration of the lack of competition across the border, these are the local markets by geographical location. They move in sync, which means essentially they are not competing on the trading floors. They're just moving together. So we look at market efficiency indicator, which is the turnover ratio of turnover over market capitalization. The EU scores even below China and Japan. Of course, turnover cannot be considered as a sign, necessarily a sign of market efficiency, but ultimately, if you have more market turnover, it's highly likely that your market is more liquid. So let's force a bit our reasoning here, and I think you understand what I'm saying. In fact, if you look at this is a bit chaotic chart. I took essentially the first, the 10th, the 20th, the 50th, the 70th, the 100th most liquid share in different markets, in Spain, France, Italy, Germany, the UK. If you see the competition of newcomers, of the MTFs and so on, stays at the top of the book. After the 50th most liquid share, liquidity drops very quickly to zero, which means they are only competing on the top of the book. While we want to foster a competition on all the book, but also on a geographical dimension, not just on a domestic dimension. which is the problem today. So I think that the merger between Deutsche Börse and LSE could actually start to put some seeds on having more competition at European level. And I think Euronext is also an example of an exchange that tried to develop more pan-European market infrastructure. We're still not having that cross-border activity that we need, for instance, pan-European IPOs. I mean, we have potential market of 500 million shareholders out there, and we are still issuing only within domestic borders, which is completely anachronistic. I mean, it doesn't mean that you have to sell your shares to the household in Portugal, but there are certainly investment funds that are raising money in Portugal that would be interested to buy shares from a French company that issue an IPO on a pan-European basis. Right, so in fact, that's what I want to share as well. A sign of different equity market structure. The US, the vast, I would say almost half of the equity holdings is in households. And so the activity of households in the US financial market is much more active than what it is in Europe. And also because the accessibility to equity markets there is much easier than in Europe. Now, another striking picture is the fragmentation of investment fund industry in Europe, which tells you also the lack of competition in the investment fund industry. We have about 33,000 investment funds in Europe, 33,000, compared to 7,000 in the US, 4,000 in Japan, 1,000 in China. The average size of investment funds in Europe is 186 million euros, compared to almost 1.4 billion euros in the US. Now, we shouldn't get here necessarily, but between these two numbers, there's so much difference that necessarily affects the cost of investment products, because an 100 million euros fund will never be able to reach economies of scale that are high enough to produce transaction costs that are as low as an investment fund of 1.4 billion. And this also creates problems of investments, because small investment funds, they tend much more to invest on, be more risk averse. So in the sense that they don't move easily cross-border if they are too small. They essentially tend to invest on very safe assets, and they don't invest on the assets perhaps that are more important for innovation and for economic growth, ultimately. So this is an interesting view. And also, let's look at insurance and pension funds. Insurance and pension funds in Europe, after the crisis, they mainly invest in fixed income. The equity share has gone, is very limited, compared, for instance, to the United States. But if you look at the composition of their equity holdings, only 30% of their equity holdings is in listed share. They invest mainly in unlisted shares, which tells you again, if insurance and pension funds do not go on listed markets, how are our markets working if they don't even try to invest on our public markets, at least the majority of their equity holdings? I'm not saying they have to invest all their assets in equity, but not even half of their equity holdings is invested in listed share. The United States, this number is 90%. So you're losing trillions of euros of potential investment in listed share, because our equity markets are not sufficiently active and liquid on a cross-border basis. Now, having said that, I'll go to the recommendations. Now, what we have done here in the what you need to understand, first of all, the Capital Markets Union is not banking union, and for different reasons. It applies to the whole European Union, and it applies to a multi-currency area. So Capital Markets Union doesn't need to have one single currency. I showed you at the beginning, one of the conclusions of Chapter 3 is that the single currency had a very limited role in the integration of financial markets. It had a positive role for some very liquid government bonds or fixed income markets, but had a very, very limited role for the overall financial markets integration. So this is compatible with a multi-currency area. It doesn't involve a new institutional framework. We're not creating new institutions with CMU. We are fixing the institution that we already have. And there's no need to create an institution like the Deposit Guarantee Scheme, the Single Supervisory Mechanism for Banking Union. There is no public risk sharing, so there's no public money involved, not at least directly. and there is no trigger event. So there is no crisis that we are facing in our financial markets that we had to deal with intervention like in banking union. We had Cyprus, and thanks to Cyprus, we have a single resolution fund today. The methodology that we use essentially is, I'm not going to the theoretical structure how we spotted those barriers, but we looked at three main areas. Price discovery, so the information flows. If I'm an investor who wants to invest cross-border, the first thing what you want to know is information about the underlying assets and about financial instruments. Can I find this information? How easy it is? What kind of information can I gather? Execution, so accessibility to financial markets. And enforcement, which is the strongest aspect in a capital market transaction. So the ability of public and private enforcement mechanisms to work well. When we look at price discovery, what you look mainly at comparability of information. So you take a piece of information from a French company and German company, and you bring them together. Can you compare this information? I'll show you in a second. Execution, the fairness of accessibility to markets. Can you access markets cross-border in an easy way? Are there barriers to access markets cross-border? Enforcement are the rules and procedures that essentially regulate a financial market transaction. Because as you know, in a financial market transaction, you deal with several agents. You don't deal with one agent as in a typical traditional bank loan where you have one institution and one borrower. So you need to have public and private enforcement mechanisms that help the parties that have weaker contractual power to essentially force the other side to deliver, to perform. So that's really important. So we looked at those barriers. We look at all these barriers that affect these three elements, but we distinguish between those that should have a priority because they create cost unpredictability. So what is a capital market transaction? Is a discounted cash flow of prices of an asset based on information about the future value. Okay? So we think the value would be, 100. You discount that value, and then you have a price. Now, any type of information that is wrong, that is misleading, that affects your ability to put a price in the future and discount that value, will affect your ability to price. So if you miss pieces of information in that process, your ability to price is impaired. So the more information you miss, the more it's likely that you will not trade. So at this moment in time, cross-border trading involves so much of information, lack of information, that doesn't allow investors to price. And I make the example of banks in IFRS 9 applied to non-performing loans. We expect foreign investors to come to Italy, for instance, and take over several banks and buy half of their non-performing loans. But the first two questions that they get answered when they arrive there is that, who is sending you? Which might create some questions of governance. And secondly is, the second question is how you price these loans. And unfortunately, we realized last December that these 4 banks that went into bail-in were disclosing value of non-performing loans at 4 times the market value. Now, can be the double, can be under 50% of the market value, but 4 times is a completely misleading number. So if you expect an investor to come in and take over your non-performing loans at 4 times the market value, forget about it. So these are type of information barriers that we try to explain. So in the area of execution, we think that the situation is not that bad. I mean, yes, there are problems with distribution channels. They are closed. Some countries, they are closed because of national marketing rules. There are static execution policies in most of the country. There are cases even of discrimination of tax treatment or in the authorization procedure. But most interesting, there is a barrier created by withholding tax procedures. As you know, you may not know, but about 8 billion euros in Europe every year gets lost because of withholding tax procedures at national level, which are unduly or unnecessarily overburdening investors, that in the end investors are not reclaiming those taxes. Now, our recommendation here, and I select just 3 of them. First, we would like to see a uniform application of more ex-ante transparency, like the key information document, beyond the investment funds usage and beyond PRIPS. So to use this template as a standard template for all financial, insurance, pension fund products, to use across all financial products, where the investor has to understand the financial risk and doesn't have enough information or has too much information. Because you can have a lack of information, but also an information overflow if you give them 500 pages prospectus or 500 pages documentation about their financial product. We also call for a review of marketing rules at national level to see whether there is discrimination based on domestic laws, and then a uniform tax reclaim procedure. Here we're not talking about harmonizing tax headline rates. We're not talking about tax bases. We're not talking about the substance of taxation. We're talking about only procedures. What are the forms through which you essentially can ask back your withholding tax? Can you send it in English, or you need to hire an accountant locally that goes to the fiscal agency and gets the money back? These are things that, summing them up, make a very important sizable cost for cross-border investing. And this is our for execution. And we all in the report, I mean, you have others, and they are all explained into detail. I'm taking a more kind of high-level role here. Data comparability, we're getting worse. Then execution is not that bad. Data comparability, it starts to look bad. It's poor. And here we find the highest number of barriers, 16 barriers, of which 4 need immediate action. So 4 creates cost unpredictability. So what we see essentially is that there are, first of all, opaque internal valuation models. I made the example of non-performing loans, and in fact, the definition of in IFRS 9 of lifetime losses is based on when there is significant increase in risk. What does this mean? Can mean anything. So every national accounting regulator has interpreted this definition in a different way. So the ECB, the first problem that the ECB had in 2014 is how to put together this number of European banks, because every bank had its own interpretation of lifetime losses. So every bank had its own interpretation of non-performing loans. So the first thing they had to do is introduce a European definition, a Eurozone definition of non-performing loan, which has been not implemented yet. So some countries they're doing, some others no. But that shows you also another problem which goes then into enforcement, is that accounting rules, it doesn't matter whether they are harmonized at European level. It matters if they are enforced in the same way. In fact, in the United States, the accounting standards are enforced by the SEC. They are not enforced by local states. They are enforced by one federal agency, which in this case could be ECMI. At the moment, there is only a forum in which every national supervisor brings a case study and says, oh, that's how we interpret it in the UK. If you want to learn something, otherwise, do whatever you want. So that's not a way to boost convergence in supervision. Now, we have, it's really weird, we have in the EU 28 business registries that are collecting information about companies that do not talk to each other, sometimes are very costly to access. They have their own standards. The information they provide cannot be reconciled at European level. What we suggest is that what is the political cost, besides the economic cost, because it's zero economic cost, but what is the political cost of creating a European business registry? To link all the 28 business registry. What is the diversity at national level that has to be preserved here? Besides some entrenched, old-fashioned commercial interests. So again, this company filings is the same. It's about information of listed companies. The companies produce much more information. Why not ESMA can actually take the role of bringing together all information about company filings that can be done on the way the US does with the EDGAR system. And it's electronic. Everything is electronic today. This really has nothing. I mean, if you sum up these things, they look trivial if you look at it. But if you sum up that, they are really a substantial part of transaction costs on a cross-border basis. Now, another point is about accounting standards for unlisted companies. I do understand there is a lot of pressure from corporates not to change anything, but never has been here. Today like this has been, the 50 years like this has been always like this. What I make the example of the United States. United States, again, they had the US Jobs Act. They introduced a easy regime, accounting regime for emerging growth companies. I think they're called like this. That are the equivalent of our mid-cap SMEs. Only 16% of those firms have opted in for the new accounting regime that should actually be less costly for them, provides less administrative burdens. This tells you that in accounting standards there is a lot of path dependence. So firms are used to these procedures internally, and even if they get a benefit of changing the accounting system, they don't come to you and tell you, I want to change it, because there is an sunk cost involved in changing those processes internally. So there I think we need to recognize that there is a public good entrenched in the fact that accounting standards of unlisted companies are not comparable. They do not allow to create sectoral benchmarks. If you don't have sectoral benchmark, you don't have high-yield investment markets, bond markets, for instance. And high-yield bond markets are a backbone of the financial system, because on the one hand you have the yield curve, safe assets, that helps pricing, but on the other hand you also need the high yield markets, risky markets there, where you can actually price the market premium. And I get to a close. I will jump this part and I close with enforcement. Do I have 5 minutes?
5.
Only, okay. No, if you need one, I stop. I can also stop. It's not a problem. 3. Okay. Enforcement is the weakest link in Europe's capital markets. Here we identified 11 barriers, less than price discovery, but still 7 of them require immediate action, because those barriers are impeding cross-border activity directly. The quality of implementation of your rules is the first element. The judicial review and the quality of courts and private settlement system, like redress procedures, and the sanctioning powers at national level. I'll show you some example. I will take, for instance, the review of ESMA, of the European Securities and Markets Authority. Every financial market has common financial institutions. There are no financial markets where you don't have an institution running the show in terms of enforcement, the listing of companies, and so on. In Europe we have ESMA, but ESMA is a strange beast. It's based on a peer review model in which even the management doesn't have voting power. So in our view, there is a problem with ESMA in terms of internal governance and external governance. In terms of internal governance, I make the example of Article 17 EU of breach of EU law. So there is a procedure in which ESMA can start an investigation against a member state that is not applying EU law. What this procedure requires, essentially requires the chairman, so the chairman, helped maybe by a couple of people in his office, to put together information about an investigation against one member state or more member states, then take this information and bring it to the Board of Supervisors. The Board of Supervisors are actually those, are all the Financial Markets Authority, so are those that are essentially investigated by the chairman of ESMA, that goes there and say, okay, guys, I want to start a procedure against you, and you. Could you please approve it? Because they have to approve it. So it's not that this investigation can be run independently by the chairman. So the chairman has to get approval by the board of supervisors, then the investigation is moved at the European Commission, and the Commission can then issue a legally binding regulation that will apply directly at the member states level. We say that this is essentially not a big problem of independence that make the representation of a EU-wide interest not existing in ESMA, because they don't vote and because the procedure through which they implement EU rules is not working. In fact, there is no one procedure under Article 17 in the last 6 years of ESMA activity. And this year is the year of the ESMA review. It would be interesting at least to fix the internal governance. And I don't want to talk not even about the new competencies, roles that ESMA could play, but at least let's start to fix the internal governance. For the external governance, I mentioned the accounting rules. Accounting rules cannot be left at national level. The interpretation of accounting rules has to be homogeneous across the border. Otherwise, there is no comparability of information. And same thing applies to some competence. I'm not going to the details of other areas which we think could be extended. For instance, the listing of UCITS. UCITS is a pan-European product by definition. Why cannot be authorized by ESMA? But besides that, competencies of some specific entities. Now we had the auditing regulation. You have been also played a role in that. I think that was a missed opportunity, because auditing companies are by nature pan-European. They are like trade repositories, they are like CCPs, they are like ICSDs, they are like market infrastructures that are pan-European in nature. So why not this competence under ESMA? ESMA today already is supervisor for credit rating agencies and trade repositories. The extension of this competence is, of course, linked to an increase in resources, because these guys, I mean, I also advise ESMA. I sit in the group of economic advisors, and I come from time to time here in Paris, and you see they have a lot of work. They're unable to cope with the amount of work that they have on their shoulders. And I close, and I finished. The other two, of course, the other point is insolvency proceedings. You know, the Eurogroup has started a discussion in February, has issued a statement in April. What we do in this report, and what we believe is feasible, is not to introduce a 29 regime or a maximum harmonization approach. This will never work, because insolvency laws are entrenched in national contract law, in national private law, and they are enforced by national courts. And national courts are not pan-European, or they apply national laws. So what would be best is to look at very specific areas of insolvency laws where you can actually harmonize. For instance, the use of secondary proceedings, so the possibility to open secondary proceedings anywhere around Europe when a claim has already been defined by EU law to be settled in one country. If you have a Dutch-German bank, the EU law already decides where the insolvency has to take place. But if there is a German creditor against any of these two parties, he can open at any time a secondary proceeding in Germany on the discretionary decision of the German judge. This has been happening with the Icelandic banks. The Icelandic bank's case should have been resolved in Iceland according to EU law. The Dutch authority, Dutch judge, stepped in and froze bank accounts and said, okay, no, you're not going anywhere. You're not taking money out of Dutch banks. So, again, these are things that can be fixed by putting inside very specific conditions when you can open secondary proceedings and so on. We also talk about consumer agency at the ESMA level, and also the creation of a national ombudsman. So there is a lot in this report. I think I've needed 3 hours to give you all the details of all the proposals. But you know, my contacts, you have them. If you want me also to give you more details at the end or later on, I'm happy to do that. And I would stop here.